Is subject to financing a scam? How does it work? What are the pros and cons of it? At the moment, subject to is one of those buzzwords floating around the internet when it comes to real estate investing. And in today's video, I want to talk about it in more detail. I want to talk about the pros and cons of subject to financing, when it works, how it works, in addition to why it might not be quite as easy as a lot of people out there make it seem to be. Now, one thing I want to make clear up front in this video is subject to financing is not a scam. It is a real type of financing. It works. People do it all of the time. And I want to spend some time and actually walk through that process, though, because there's a lot of things that people don't understand when watching other people on the internet, listening to different podcasts when it comes to subject to financing. Like I said earlier, listening to these people who are selling courses on subject to financing. Again, there's a benefit to them in selling this. They make it sound a lot easier than it actually is when it comes to it. And they don't really talk about the risk so much when it comes to subject to financing. So we're going to spend a little bit of time and talk about it today so that you have full transparency and can decide whether or not it's something that you really want to go after and focus your time on when it comes to real estate investing. Now, before we dive into that, do me a favor. If you're finding any value in this video at all, hit that thumbs up and feel free to subscribe to the channel to stay updated on everything real estate related. So let's start with a clear definition of subject to financing. What is subject to? Subject to financing is when the investor or purchaser takes rights to the title for a property while the seller's existing mortgage stays in place. In the simplest terms, the real estate deal is subject to the seller's mortgage financing the deal. Subject to financing is a creative way to invest in real estate. So in layman terms, what that means is you're essentially getting the seller to agree to transfer the deed, the title of that property into your name while keeping the mortgage in their name. So you're probably watching this going, who in their right mind would do that? What seller would transfer the title out of their name while keeping the mortgage, the risk, if you will, in their name? Well, there's usually two types of sellers that would consider this type of financing. And it's a seller that's in distress, that has little to no equity in a property, and they need to get rid of that property. And in most cases, they're not able to sell it for more money than they owe on the property. Therefore, this is something they would consider a subject to deal. And another situation might be a wholesaler has found a deal and you're saying, what is a wholesaler? Wholesalers are typically real estate investors looking for sellers that have pain, that are looking to get out of deals for one reason or another. And what happens is a lot of times wholesalers are lowballing, these potential sellers, if you will, these potential subject to deals, whereas they're offering less money than the seller wants on those transactions, or maybe less than that seller needs, and therefore that potential seller could be somebody that would also be willing to consider a subject to financing deal as well. Now again, how does this work? Well, the mortgage stays in the seller's name, and you, as the one getting the subject to financing, you're actually the one making the payments on that deal. So let's say, for example, you approach a seller that wants $100,000 for their property. And let's say they owe somewhere around $100,000. Maybe they owe a little bit less, but you're paying them a little bit more just to take over the deal, not having to incur additional fees from title, escrow, that sort of thing. So you're just doing a subject to deal in this case. So basically what happens is the seller and you have an agreement to transfer the title out of that current homeowner's name into your name while keeping the mortgage in their name. And in the cases where you can get a seller to agree to this, you're actually getting a title company involved in doing a true transfer of title. So there's a title company drawing up a grant deed where the current seller is actually going to sign that deed, transferring the title of the property into your name while the mortgage stays in their name. Now you're probably watching this going, what are the pros for the seller in this case? Why wouldn't they just sell the property? Like I mentioned earlier, maybe they're upside down on that property. Maybe they need cash quickly. Maybe there's some cash exchanging hands on these types of deals, because that can happen as well. But more or less, you're getting that seller out from underneath that property. Maybe they're close to foreclosure. Maybe they're behind on their payments. They're getting ready to foreclose on that property. And by you doing the subject to deal, part of the agreement is that you're bringing the payments current. That might be a circumstance where the seller would consider doing a subject to deal. In addition, some of the other pros of selling a property this way are less cost involved, less upfront cost for the seller and for you as the investor. It's usually a faster transaction, so you're getting that person out from underneath that property quicker by doing subject to financing, on top of you as an investor not having to qualify to purchase that home. Nobody's going to check your credit. No one's checking your bank statements, your assets in any of these deals. And by doing this, you're actually getting more profit as an investor when you take over these transactions because there's less cost involved. And in many cases, you're getting more favorable interest rates, especially with interest rates at the moment sitting somewhere around 6%. Some of these deals that you might be able to do a subject to deal on may be one of those lucky homeowners that locked in a 3-4% interest rate just a couple of years ago. And they're in a circumstance now where maybe they had a job loss, or maybe they're in an area where homes have pulled back in price and they have little to no equity in that property because they put little to no money down to start with, and they're just looking to get out. Now, with all of that said, there are some downsides to doing subject to as well. And the most obvious one, and the one that's all over the internet, and that's the due on sale clause. This is lenders putting special verbiage into their mortgages and trust deeds that give the lender the right to accelerate the loan and invoke a due on sale clause in the event of a transfer. It means the loan balance is due in full, and that could put the homeowner at risk of losing the home if the lender finds out about the transfer. So basically a due on sale clause. So when you sign your loan documents to purchase a home, one of the paragraphs in that deed is going to have something related to the due on sale, which basically means that if that property transfers names, that gives the right to the lender to call the loan due, which basically means that they could call the current seller, they could write them a letter basically saying, hey, look, we see that you have transferred the property out of your name into someone else's name. We now want to be paid in full. And this is a really big risk as someone that is selling a property to a subject to investor, because you've basically given your rights to that property away by signing over that grant deed to the new homeowner, if you will. So if you agreed to these, so let's just say you were a seller and you had an agreement with, an investor buying subject to financing from you, let's just say for $400,000. Just say that's what you owed on the property. Well, you've transferred the title of that property out of your name. So now you no longer, in theory, own that property, but you kept the mortgage in your name. So when the lender goes to call that loan due, if they did, you would be the one responsible to come up with that payment, even though you have that agreement and in theory have given that property to someone else. Now, I don't want to spend a lot of time talking about due on sale clauses, but in reality, it is the biggest risk for a seller out there. And as an investor looking to do these subject to deals, you need to understand that. If you're trying to get a deal subject to, this is going to be a question that you're going to have to address. Many sellers out there are going to wonder, well, what happens? What happens if the lender actually calls my loan due? What happens if you stop making payments on the mortgage and the property goes into foreclosure and my name is on the mortgage? Like, what happens in these scenarios? So that's what you have to think about as an investor. But as a seller considering subject to financing, you really need to be thinking about what happens in the case of due on sale. Now, as I mentioned earlier, this is not something that's likely to happen. In the people that I know, the videos that I've watched, the real estate investors that I've had firsthand in speaking with, they haven't encountered a situation where they've actually had a due on sale clause. But in all reality, it could happen, and it's something that you need to be aware of. On top of that, some of the other cons when doing subject to financing is that insurance can be complicated for the person that's actually getting the subject to financing. And I've also seen cases out there where homes have been seized when the seller actually went into bankruptcy, even though the title was in someone else's name. Now, I haven't seen that firsthand, but I have read some cases on the internet about that potentially taking place. So it's something that you need to be aware of if you're considering subject to financing. Another con of being a seller and considering subject to financing, not only do you have to keep the mortgage in your name, but you're likely putting yourself in a position where you might not be able to purchase another home. Now, what do I mean? Well, let's just say you're buying a property. I heard this example online. Let's just say that you're buying a property, a new construction property, and in turn, you're having to sell your property. And let's just say you got to sell it quickly. And so you consider a subject to deal, just to get it into escrow. So you've transferred the deed into the new investor, the new buyer's name, but the mortgage is staying in your name. Well, when you go to get financing on that property, the lender, in theory, is going to count that mortgage of that subject to property against your monthly debt because the mortgage is still in your name. Now, I know there are people out there on the internet saying, well, that's simply not the case because you just show them that you transferred title to that property. Well, in all reality, even though the title is transferred out of the seller's name, the seller is still responsible for paying that mortgage. They're the ones that sign the original loan document. So they're still on the hook for that loan. So if the investor, in theory, stopped paying on that loan, the seller would be the one responsible for making those payments. So the lender is going to look at that mortgage debt as the debt of the seller and, in theory, count it against their debt to income ratio. Now, the reason I say in theory is because there are people out there on the internet that are famous for talking about subject to finance, saying this is not the case, and they've talked to lenders about this, and lenders are saying that that mortgage wouldn't and shouldn't count towards their debt. Well, I was a mortgage broker for over 10 years, and the first time I heard this, it immediately threw up a red flag for me, because I said, well, the lender is still going to count that debt against that seller, even though the deed, the title is out of their name, because they're still on the mortgage for that property. And so what I did was I called some lenders, I talked to my lender, and they confirmed exactly what I said. Now, I have heard some other people saying, well, once the investor can provide, 6 months or a year's worth of payment showing that they made the payment on that mortgage, then the lender won't count that mortgage debt against them when they're buying a new property. And that's also not true, because in doing my research, the lenders out there want to see that the person that's actually making the payments is also on the mortgage. So in this case, they're on title, but they're not on the mortgage. So based on the conversations that I've had, the lender is still going to count that mortgage debt against the original seller of that property. Now, I can see the case of, say, a credit union and or some sort of portfolio lenders out there allowing that mortgage debt not to count towards the debt to income ratio. But the majority of lenders out there, conventional lenders, Fannie, Freddie, USDA, VA, FHA, are going to continue to count that debt against the original seller, putting them in a tough position to buy another home until that loan is paid off in full. Now, a moment ago, I was talking about the due on sale clause. Now, there are people out there at the moment on the internet talking about due on sale insurance. It's an insurance that you can purchase on behalf of the seller that basically says, hey, look, if the lender calls this loan due, the insurance will step up and make the loan whole and essentially give you the same terms as you had before with that insurance. Now, I've scoured the internet, I've clicked on links and other videos where people said they had these insurance companies, and quite frankly, I can't find anything out there that shows that due on sale insurance is actually something that exists. Now, if it does exist, it's a good thing, especially for the seller. And it's something that investors should definitely consider if they're doing subject to financing, because not only does it protect the seller, it also protects the investor as well. Now, while we're on the subject of due on sale, I've actually seen some creative ways to deal with this up front when negotiating a deal, basically telling the seller, hey, listen, if this loan is called due on sale, then essentially what we'll do is we'll transfer the deed back into your name. So therefore you own the property again and you're back on title. So you essentially meet the requirements that the bank wants to see, and therefore they wouldn't be calling the loan due any longer. And in turn, what we would do is set up a lease option to buy at 0% interest for the remainder of the loan. In theory, doing the exact same thing, but keeping the mortgage and the property in the seller's name while still having rights to that property as an investor. Now, the downside to this is, as an investor, you're not going to be able to write the depreciation off on that property because you're not on title to that property. So in theory, you could be losing some of the tax benefits of owning that property. Now, before we get into why some of these subject to deals are going to be very complicated and quite frankly difficult to come by, let's talk about a couple of different ways to actually do subject to financing so that you can get an idea of how they work. The first one is a straight subject to cash to loan. Now, this is the most common, and it's when a buyer essentially pays the difference between the purchase price and the seller's existing loan. They pay that difference in cash. For example, let's say you agree to buy a property for, say, $500,000. The seller owes $400,000 on that property. You're in theory giving them $100,000 to make up that difference. Now, the second type, in my opinion, is the better option if you can get a seller to agree to it, and that is a subject to with seller carryback financing. And this is where the seller is actually acting as a bank, if you will, and doing owner financing in the form of, say, a second mortgage. An example of this would just say, let's say you agreed again on a purchase of, say, $500,000. The seller owes $400,000, so there's a gap of that $100,000. And let's say you agree as part of the deal to give that seller an upfront fee of, say, $30,000. So there's still a $70,000 gap there. In this case, the seller might do owner financing for that $70,000 and spread it out over, say, 5 years, 10 years, whatever both parties can agree on. Now, earlier in the video, I mentioned I would talk a little bit more about subject to financing and why it might not be exactly what you think and why it might be a little bit more difficult out there to get these deals. Now, like I said, the internet makes it sound really easy. You just go up to a seller who's in distress, who needs money, and you propose this option of subject to. Well, typically a seller is only going to agree to something like this if there's a benefit to the seller. So in the case that you're an investor and you think you're just going to walk into some of these deals and not have to pay any money at all to the seller, and they're just going to essentially transfer the deed into your name and allow you to pay that mortgage, I think is a bit naive. Most sellers are going to want to get something out of the deal, which means as an investor looking to do subject to financing, in some cases you're going to have to pay them cash. In some cases you're going to have to pay them maybe more money for the property than they currently owe on that property so that you can get them to agree to it and accept that additional risk by keeping the mortgage in their name. In addition, over the last couple of years, sellers have seen more equity gained in their property than ever in history. So a lot of sellers at the moment are sitting on a ton of equity, which means that if they're in distress, they need financing, they're in a better position just to sell that property outright versus needing an investor or somebody to do subject to financing. They're in a position where they have equity in that property, and assuming they have a little bit of time on their hands, they're better off putting that property on the market and likely getting more money for that home than dealing with an investor trying to do subject to financing, and at the end of the day putting themselves at risk by keeping the mortgage in their name. So if you're a real estate investor out there and you're just learning about subject to financing, or maybe you're just learning about investing in real estate and really want to start with the basics, do me a favor and check out this video here.